Happy Monday morning to you as I come to you from the trading floor at about 8:49 a.m. on Monday, July the 14th. We take a look at the developments over the weekend and the week ahead in the commodity markets. Things got a little bit more interesting again over the weekend as on Saturday, President Trump reportedly sent letters to the European Union and to Mexico putting 30% tariffs on them. Now, that's rather interesting, a 30% tariff on Mexico versus a 35% tariff on Canada placed late last week. Mexico being our largest trading partner, essentially, in many different areas. European Union, one of our largest trading partners. And so it seems that he kept the letters for the largest trading partners to the last, still trying to get agreements. The European Union has voices on both sides, with some wanting immediate retaliation and others wanting quick negotiations to a solution. I think overall, the European Commission president wants to reach an agreement. The European Union and the United States have many differences, but they also want an agreement. When you look at what the European Commission wants, they've offered basically, from what we read, a 10% to accept a 10% U.S. tariff as long as they can protect certain areas. Well, that's the way President Trump is too. He wants to protect certain areas, and unfortunately, those areas that both want to protect conflict with one another, and that's where some of the real problems are. So, can they reach an agreement? That's yet to be seen, but at least they're talking, they're working on it. President Sheinbaum wasn't happy about the 30% tariff. She said, we will protect our sovereignty, but she refrained from criticizing President Trump. I think she perhaps has done the best job to this point over the last few months of working with President Trump. And she said that a working group has already been established to negotiate an agreement with President Trump. So hopefully some agreements will be worked out and we'll see these tariffs go away or at least reduce significantly. So far, we only have agreements with Britain and Vietnam going forward. But the markets are responding to all this rather well to this point. If you remember back in April, we saw that the markets basically traded immediately the worst case scenario, worst case possible scenario, that this could result in a world trade war that pulls the global economy into recession, reduces demand for commodities, etc. And that is still possible. But as time goes on, the market starts to move away from that worst case scenario and starts to become desensitized to all of the headlines. We saw a similar thing happen with Russia's invasion of Ukraine back in February 2022. The immediate response is to price in a worst case scenario. In that case, it was bullish for the commodities, as that region of the world is the world's largest exporter of commodities. And so energy and food-based commodity prices really reflected fears that exports from that region would be curtailed by some degree. That never really happened, although there were periodic interruptions. Back then, if we saw a port in Ukraine that loaded cargo ships of grain attacked by Russia, we'd see a big response in the markets. Today, we barely notice it in the markets. It's become somewhat routine. They become desensitized to it. And that's kind of what we see happening. Markets adjust, they become desensitized to bad news, so to speak. And that's what we're seeing happen now. Now, we could see something totally different around the 1st of August, but for now, that's the environment we're in. So when we look at the commodities, we are seeing the crude oil market show some concerns about potential tightness of supply at Midwestern refineries because they're very dependent upon Canadian crude oil. We're seeing the soybean market start to trade some concerns that China, which typically really ramps up its purchases of U.S. soybeans for fourth quarter delivery, is basically absent, not being seen anywhere in the market, so to speak. And so soybeans are now starting to take notice of that. But otherwise, they're really trading regular supply and demand fundamentals, which I'm going to go into. On Friday, we did see USDA release a major crop report for the grain and oil seeds. Essentially, increasing corn exports by another 100 million bushels but cutting feed usage by 75 million bushels. And so we see that overall, this pattern that we're going to be shipping more corn to Mexico and feeding cattle down there because the Mexican border is closed to what once was about 30,000 head of feeder cattle per week coming north to U.S. feedlots. That's not happening. So we feed the cattle down there. That means they need our corn to feed it because they don't have the corn to feed them. And they max out what they produce and they import the rest from us for the most part. And that's going to continue and that's going to increase, and then they'll ship the meat to the United States. So that will continue going forward. Now, the fact that that meat may face a 30% tariff is again another challenge, particularly after the 50% tariff that was put on Brazil last week, and Brazil being our number one provider of beef on the import market, 27% of our beef imports coming from Brazil. So this is something that the beef market will certainly be watching very closely. Now, products, so everything I've been able to discern, although I haven't seen it specifically stated, it's widely believed that those products covered under the USMCA will still remain exempt from these new tariffs for both Canada and Mexico. Key, of course, is going to be how do these countries retaliate? Do they retaliate? If they do retaliate, what products do they retaliate on and at what level? President Trump has threatened that any retaliatory tariffs will be added on to the existing tariffs, like what he did with China initially until the 90-day rollback was announced in May. So again, this is something we're going to have to watch how this develops between now and August 1st, and then beyond August 1st if we fail to have agreements. So the uncertainty continues here at this hour. With China, Secretary of State Rubio met with the foreign minister of China at the close of last week. It's said to have good meetings that they had. Secretary Rubio stating that he'd really like to see, and he's hopeful that we'll be able to see a meeting with Xi Jinping and Trump happen soon. Again, the two sides are very far apart on some key issues, but talking is better than not talking, and the markets are taking some encouragement from that. This is the beginning of earnings season this week. It's also when we get inflation data, the CPI data coming out on Tuesday, the PPI on Wednesday, retail sales on Thursday. All of these factors will tell us how the economy is adjusting to the new tariff world that we're in right now, and the market will make adjustments accordingly. Now, I want to go back again to the grain and oilseeds and what we saw from USDA on Friday. And basically, the expectation now is that while demand is overall good, and USDA acknowledging biofuel demand should be very strong for soy oil, canola oil, etc., in their report on Friday, there are still an expectation, and why we saw prices go lower on Friday, one big reason, an expectation that this year's crops are going to be big. We'll get an update of crop condition ratings this afternoon. The general expectation is that it's going to continue to show very large crops. Yield models have been showing that this year's corn crop, well, let me go back and give an explanation overall. The condition ratings of the corn and soybean crops tend to be highest in June, and then because they're a visual representation of what the crop looks like. And the more a crop ages, it's kind of like the rest of us. We get aging spots and wrinkles, etc. We don't look as good as we get older. And so the crops are that way as well. So condition ratings are always the highest in June, and then they trend lower through July into the middle of August, when they tend to bounce on average. Now, if yields, as we start the harvest and yields come in worse than expected, they'll continue to decline based on hearing those yield reports. If the yields come in better than expected, then they'll get a bigger bounce yet. So that seasonality of declining condition ratings through July into early August that seasonality is built into the crop yield models. And so when the yields stay flat into July, as what soybeans have this year, the yield models elevate the yields because they have not the condition ratings have not declined per normal. Corn ratings are actually going up against the seasonal tendency for them to go down. So those yield models have gone up even faster, with my yield model right now pushing 187 bushels per acre. I've seen some out there that are up around 190 bushels per acre. Some are lower, around 183, 184 bushels per acre. But mine is probably in the middle of the pack, um, of showing what the crop yield potential is. Now, let me explain how crop models work. A crop model in July is not saying the crop is going to yield 187 bushels per acre. What it is saying is this is a snapshot of the crop's yield potential based on the condition of the crop on this date. That will change, either getting better or getting worse as we go forward. Now, the saying in the industry is that the corn crop is made in July when it pollinates. And to a great extent, that's true, because pollination is the point at which adverse weather can have the biggest negative impact on yield. And right now, the weather is very good for pollination of corn, and that suggests high yield potential. Then when we get into August, what we have found, and goes back to our yield models are very good. And if you look back over the last dozen years, the average error of my yield model is 0.1%. Now, it will overestimate yields in years when August, which is the time when the grain fills in the crop, if August is hot, that speeds up the maturation of the process. The crop matures much more quickly, and the kernels will be smaller. And smaller kernels result in lower yields. On the other hand, if August is seasonally very mild, you slow down the maturation process, you increase kernel size, and your yields go up correspondingly. Now, I'm not good enough to be able to look at an ear of corn and tell if its kernels are 5% bigger than normal or 5% smaller than normal. But on 181 trend yield, if you want to accept that as the trend yield that USDA has indicated that it is, 5% bigger kernels nationally would indicate 190 bushel yield, national average yield. 5% smaller kernels would be 172 bushel yield. 190 bushel yield would argue for ending stocks above 2 billion bushels. That's fairly bearish. 172 bushel yield, based on our current expectations of demand, would see stocks around 1.1 billion bushels and be considered pretty bullish, pretty tight supplies that the market would need to ration demand with higher prices. So size of kernel matters a great deal, and you can get much more than 5%. You can be 10% or more. So that can make a big difference. And so the crop ratings right now give us our snapshot of what the yield potential is today. Now, one thing that those condition ratings don't pick up on is pollination. If pollination, it assumes good pollination. It can't tell whether each of the spots where a kernel develops has been pollinated or not, because we're just looking on the outside of the husks and the plant as a whole. If in fact there are pollination issues, the crop ratings will not pick up on that. I indicated that thus far this year, the weather conditions for pollination for the most part have been quite good, thus the expectations of high yields. I am now starting to hear scattered reports in the southern Midwest where the crop is pollinated already of some significant pollination issues. And some of the pictures that have been sent to me would indicate it's like the corn had been in a week of 100-degree temperatures and under significant stress. Now, how widespread that is impossible to know right now, but it is something to watch. And these reports seem to be moving north with the corn pollination. Now, maybe this will turn out to be not a significant issue at all, and we'll still have a big crop, or depending on what August weather is. Or maybe this is. What I'm saying is when the funds have as big as short positions, right now it's thought to be around 1 billion bushels of short positions, 200,000 contracts, you got to pay attention, because things like this can cause a short covering rally. Keep in mind that the U.S. farmer is undersold of his new crop. And the Brazilian farmer is undersold of his new crop. And we're hearing much larger production estimates out of Brazil than what many of the particularly noted analysts have been showing yet to this point, especially what bigger than what USDA has been showing. So there's a lot of bushels to be sold against any rally that develops. But if in fact this pollination factor does become something more widespread, it's something that could cause a short covering rally to unfold. Again, we'll have to see how widespread this is. It's too early to know if this is an issue, not something we're keeping an eye on. So that's it for today on July 14th. Be sure to like and subscribe if you want to continue to get these updates from the trading floor. And I look forward to being back with you later this week.